And again, some of the stories going around really showing what's happening. We've put this on a chart in terms of the spread between GCC bonds and treasuries. This is your JP Morgan index. Pull it down in your Bloomberg. I've highlighted with a red arrow here what happened last time the bond sales started picking up because you saw a tightening of that spread. Take a look what's happening there the last 3 months. You're seeing what could be interpreted as a reversal of that trend. Where's this line going to go, and how confident are you that these corporates, that the sovereigns are going to come to market and they're going to come with big appetite?
The key story here, in my mind, is the development of the regional capital markets. I mean, I wrote about this 3 years ago, saying that sovereigns can and should be using a much bigger use of the bond and sukuk markets. And the use of the market by the sovereigns here has been very underdeveloped. If you look up their debt to GDP, for example, it's been historically quite low. Now that the oil prices have stabilized at a lower average and it's a new norm, I would expect to see the sovereigns using the bond markets in a significant way going forward, and for it to be part of their balance sheet in a structural way. What happens when you develop the market like this is you create your own demand, and I expect the spreads actually to be quite solid.
So in terms of how foreign capital is going to be put to work here, do you expect that demand to be strong as well? And how are the geopolitical risks, which have really come to the fore again? North Korea, and more importantly for the Gulf, is the Syria story and the tensions with some of the allies there. How is that going to derail of some of the big plans from the sovereigns to come to market and to sell their story to the world?
The geopolitical risks are what makes these spreads so juicy. From the perspective of international investors, when you look at the credit rating, at the wealth of the nations here, these spreads should be extremely much tighter. If you look at some of the U.S. corporates, for example, they're trading at tighter spreads at similar ratings. So there is a lot of risks priced into our spreads, but it's crucial for the governments here to be very transparent, to have a very good policy of managing their investor base in order to maintain this demand.
Ziad, David here in Hong Kong. I'm just wondering, from an outsider just looking into this, what's really just a fabulous reform program, what we're getting there. Is it too early to start talking about an oversupply?
It's definitely too early. In my mind, this is only the beginning. And as I said, I would expect the bond sales to actually continue ramping up until you reach a plateau level. We may see oversupply at one stage if the governments, mismanage the market. They may get over enthusiastic in their issuance, but I don't think we are at that level yet. What I would like to see is a lot more of the government-related entities, the banks, and even the corporates follow suit and start developing the corporate and the private sector bond market much more significantly than what we've seen before.
From a regulatory standpoint, what would you like to see?
What would be interesting is to see the development of an institutional bond investor base in the region. Currently, the main investor base in the region for bonds is the banks. We do not have anything like mutual funds or pension funds, obviously we have insurance companies, right, but their allocation to the bond market is quite underdeveloped. Yeah.